Warren Buffett is one of the world's most influential investors, but his success is often misunderstood by the public and professionals alike. Some believe he simply buys cheap stocks or predicts markets better than everyone else, looking for quick gains in a volatile environment. The Warren Buffett Way presents a different picture. Buffett is a disciplined business analyst who focuses on patience and long-term ownership over short-term predictions. This documentary explores those principles through original commentary and explains why they continue to influence investors today in the digital age. We will break down the strategies that turned a small partnership into one of the largest conglomerates in the world. Berkshire Hathaway, Chapter 1. Think like a business owner. Buying a stock means buying part of a business, not just a ticker symbol on a screen. Instead of asking, "Will this stock rise next week?" the intelligent investor asks, "What does this company actually sell to the world? How does it make money? Does it have loyal customers who wouldn't switch for a slightly lower price? Can it remain competitive in a changing market? Can it generate sustainable profits over the next decade?" This mindset encourages focusing on business quality instead of daily price movements. Imagine you are buying the entire company as a private owner. Would you still buy it if the stock market closed for the next 5 years? Buffett views his relationship with a company as a long-term partnership, aligning his interests with the business's fundamental health. Chapter 2. Economic Moats. Buffett often looks for businesses with durable competitive advantages, which he famously calls moats. Examples include strong brands that command premium prices, cost advantages that competitors can't match, and powerful network effects. Patents, high customer switching costs, and efficient distribution networks are all elements that strengthen a company's competitive position. Consider Coca-Cola. Its global brand recognition and distribution network form a moat so wide that it has endured for over a century. Even with billions of dollars, a competitor could not easily recreate the trust and reach that Coke has built with consumers worldwide. The key is durability. A moat that is easily breached by new technology or a new competitor is not a moat Buffett would invest in. In today's fast-paced world, moats are under constant attack. An investor must decide if the moat is widening or narrowing over time. Chapter 3. Great Management. Leadership plays a major role in the long-term success of any business enterprise. Does management allocate capital wisely? This is perhaps the most important skill a CEO can possess, according to Buffett. Are they honest with shareholders? Do they admit their mistakes? Or do they hide behind accounting tricks and optimistic language? Do they think long-term? A management team focused only on the next quarter's earnings is unlikely to build a lasting competitive advantage. Chapter 4. Intrinsic Value. In the words of Benjamin Graham, price is what you pay, value is what you get. Intrinsic value is an estimate of a company's worth based on the cash it will generate for its owners over its remaining life. To be a successful investor, one must buy a business at a significant discount to its intrinsic value, creating a margin of safety. This margin of safety protects the investor from errors in calculation or unexpected changes in the business environment. Chapter 5. Patience. In a world of high-frequency trading, the ability to wait is a rare and valuable asset. Buffett often tells students to imagine they only had 20 investment slots for their entire lifetime. This forces extreme selectivity. Like a baseball player waiting for the perfect pitch, an investor should wait for the opportunity where the odds are overwhelmingly in their favor. Waiting allows time for deep research and prevents emotional decisions driven by the fear of missing out, or FOMO. Chapter 6. Rational Thinking. The stock market is a platform where emotions often override logic. Think of the market as a moody partner named Mr. Market, who offers to buy or sell your business interest every single day. Some days he is euphoric and asks a high price. Other days he is depressed and offers a bargain. Your job is to ignore his mood and focus on the facts. Ask yourself, what evidence supports my conclusion? What assumptions am I making about the future that might be wrong? Rationality requires independent thinking. If you follow the crowd, you will likely achieve the same results as the crowd. Chapter 7. Capital Allocation. A company's true value is often determined by how its earnings are used. Should a company reinvest in its own operations, acquire other businesses, pay dividends, or buy back its own shares? Effective capital allocation creates a compounding effect that can turn a good business into a legendary one over decades. Chapter 8. Lifelong Learning. Buffett famously spends most of his day reading and thinking. Successful investors recognize that knowledge compounds just like interest. The more you know, the better your decisions become. The world is always changing. An investor who stops learning will soon find their framework obsolete in a new economic reality. Chapter 9. Buffett's Ideas Today. Do these principles still work in a world of high-tech and AI? While the tools have changed, the fundamental nature of business remains the same. Understanding a business is still the foundation. Even in the tech sector, companies like Apple and Google exhibit the moats and management qualities that Buffett has always praised. The Warren Buffett Way is a philosophy of discipline, rationality, and long-term commitment to business quality. It is not a get-rich-quick scheme, but a proven path to building significant wealth through the power of compounding. If you found this analysis valuable, consider subscribing to Wealth Entertainment 21 for more deep dives into investing. Follow us on Instagram @saeed.growth for daily insights on personal and financial development. Thank you for watching.